All right, good morning. So there is a lot of stuff going on in the markets right now. And today I'm actually joined by someone who I follow on TikTok. He produces really, really great investment commentary. And I thought it would be great to have him on just to provide some insights to what's going on at the markets right now, what I guess he's seeing across the TikTok sphere in the marketplace, certainly from his day job as well, what he does for a living. He's actually been a stockbroker for 13 years, and he's the founder of Mito Markets. And I'm so happy that Tim has been able to join me today. Tim, welcome, mate.
Thank you so much. I got to say, I'm absolutely honored to be here. I've been watching your content from afar for months now, sort of hoping and manifesting that one day our paths would cross, and here we are today. So yeah, absolutely chuffed to be on here, and thank you for having me.
Nah, no worries. You know, it was one of your TikToks that you put out. I can't remember what the premise of it all was, but you were like, I think it was where someone was like, you were talking about the fact that people are buying companies and they're missing like the fundamentals around it. Like there's a reason why the stock has fallen
Yeah,
15, 20%.
yeah,
Like that isn't a signal to go buy the dip. It's like, look at the company. The
I know.
company's not a good company.
Yeah,
So why are
yeah.
you buying it if it's 15, 20% down because you're buying the dip? And I was like, we need to have a conversation about this. So yeah.
Yeah. Did you know what that actually came from? Because so often I'm just sort of sitting or standing in the background. I can overhear a conversation, with a couple of people like, I've seen this has come down 80%. It's going to be a buy. Surely it's going to be a buy. And I'm thinking in my head, what a crap company. I wouldn't touch it with a barge pole. And there's so many times I just want to interject in someone else's conversation. But yeah, it's one of those situations. And I'll give you an example. One that's really spoken about a lot at the moment is PayPal. And
Hmm.
obviously you look at PayPal and on a chart, it's come down a tremendous amount. And I think there just needs to be a bit of an understanding that the PayPal from X years ago, when it was high and mighty and sort of producing revenue growth 35, 40%, is not the PayPal you see today. It's a completely different marketplace. PayPal 8 years ago didn't have Apple Pay to compete with. So yeah, it's maybe just an understanding that stock just doesn't go down half without it being a fundamentally different company. Um, and I'll hark back probably to one of my biggest trading mistakes. Well, my biggest trading mistake. I was buying into this junior oil company called Range Resources. Absolute pile of garbage company. It was easy, very speculative. Um, and I just got emotionally invested, completely emotionally invested. They've got this oil reserve in Georgia. They've got one in Trinidad and Tobago. It's only a matter of time before they strike oil. And I just kept following the share price down, plugging it with another £1,000, goes down 30%, another £1,000. And it just got to the point where it's like, wow, I've seen £5,000 turn into like 50 quid. This is incredible. Because if you think about it, if you're averaging down, you're investing in your own stupidity. And if you buy stocks which have already gone up into your portfolio, then you're investing into your good decision-making patterns. And it's quite a common mistake I see is you've got this confirmation bias, you've got your heart set on company XYZ, goes down 10, 20%, so you buy more. Well, actually, it kind of just shows that your initial investment decision was maybe the wrong one because it's gone down.
Well,
So you're actually investing into your own stupidity. And what will happen is the ones that are actually performing well, you'll cut those profits and you get a situation where you're just cutting winners and buying losers. Probably like 101 of how not to invest. And it's
yeah.
so common, very frustrating indeed to see.
So how long ago was that with the oil company? How long ago
Oh,
was it, did you say?
years ago. So that would have been when I first started, probably 13 years ago. I knew absolutely nothing. Still don't know too much. I was learning every day. But there was this sort of excited hubbub on the trading floor. There's a few traders talking about this junior oil company. And I was just sort of the T-boy. And I was overhearing these conversations, getting uber excited that these senior traders are all sort of excited about this stuff. And I'm on the inside level. I'm hearing them talk about it. I'm like, right, let's log into my Hargreaves Lansdowne account and stick £1,000 into that. And I've got no idea what they're doing. God knows, they could be short selling it and buying it and doing everything. But I was so emotionally attached to the story. And this was if you think about it, this is a company that has nothing. They don't produce any revenue. There's no PE ratio because to have a PE ratio, you have to have earnings. There's no earnings to speak of. So we're just on a wing and a prayer that they will Black and Decker drill. Hopefully they find oil and it goes up, but it's just it was awful. Won't be going back into junior oil companies anytime soon.
Do you think, because a lot of stuff that you mentioned there is speaking to the psychology of investing,
Yeah,
and I think it's very, very easy to fall into this trap of, I picked this company. This is what I notice all the time, right? I notice people use the phrase, I believe in the company. I hear that phrase all the time. I believe in the company. And that's the justification for doubling down.
yeah,
And it's so hard to admit that, okay, maybe I was wrong. As you say, I'm invested in my own stupidity now. Let's cut my losses and then move on to something else.
yeah.
And the emotional attachment between, I've sunk like $2,000 into this thing. It's now worth
exactly.
nothing. I want a chance to get my money back.
Slicey, and it's hard to avoid. And if you say you believe in the company, if we're talking about Apple or Microsoft, these huge Silicon Valley companies that have a decade track record of growing earnings, great. If we're talking about some sort of speculative company which has got sort of little to no revenue, no earnings, then you can land yourself in an absolute world of trouble pretty quickly.
Mm-hmm. Yeah. So, with your background as a stockbroker, just explain to people what a stockbroker actually does, because I think people may not necessarily understand what a stockbroker does or did back in the day. I think they think of Wolf of Wall Street.
Yeah, exactly. Yeah, exactly. And it's almost becoming a bit of a retired term, because you don't actually hear the phrase stockbroker anymore. You hear about a wealth manager, or you hear about a trade platform like trading 2-on-2, whatever it may be, or Enquiries. So stockbroker in the most traditional sense, before easy access trade platforms existed, you'd have to actually call up a broker and say, I'd like to buy some shares in Lloyd's, and they would do that transaction on your behalf. We charge a small fee for that. You're given some shares, winner. I think nowadays you kind of now just get either a wealth manager or an online trading platform. So it's quite rare to find, stockbrokers that still exist. And it's my day-to-day job. I run a trade platform, Mito Markets, and people can log on. They can trade, whatever they want at any time. That's fine. But they also like to have access to a qualified stockbroker at the other end of the line. I'll give you an example. So yesterday I had a chap say, listen, Tim, I really want to have exposure to India, and I just don't know what to buy. Can you give me a list of ETFs or shares I can buy? So that's my job to then go, right, let's look at the most liquid ETFs, funds, what futures he could possibly buy, and go back with some research and some report. So it's a completely different level of service. And then there's also things like you might want to just give your stockbroker the keys to the money and say, listen, you make all the investment decisions. I have complete faith in you. And there's a bit of that going on. So I run a model portfolio, which is global equity growth, and it's predominantly big tech companies, but there's also other stuff in there as well, like Crocs, for instance, or WHMS, which I'm quite bullish on as well. But the theme is growth and technology with some other really good individual companies in there too. So I think stockbroker is kind of all encompassing. And when I first started out, my first job, it was very much like what you described, Wolf of Wall Street. It was horrendous. I had 400 phone calls a day, and it was you had this environment whereby someone would be fired every week if they weren't bringing in enough clients and enough assets. And we're not talking about a team of 100 people. We're talking about a team of 11 guys who are all sort of 19 to 24 years old. And there was this one horror story. I remember this chap came from his lunch break with his Subway, put it down, started to open it up. Boss, he gets the big hand on the shoulder. Don't start eating your Subway. It's time to go. And yeah, it's changed so much. You wouldn't really get that now, but there was still a lot of that going on when I was coming into the industry. So yeah, pretty toxic, if I'm honest with you. It's not that pleasant.
The funny thing though is that I think a lot of people look at that and think, oh, that would be so amazing. I'd love to be in there, but it's like it's so cutthroat. And how you make 400 calls a day, bearing in mind you're probably only there for 7 to 8 hours a day. That's constantly dialing. That's constantly being in front of people, and you have to be quick about it as well to get your numbers up, get the transition through. It's a completely different world. It's mad.
I couldn't do it now. You could only do that as a young man. And I get there at 8 and then sort of work till about 7, 8 in the evening. And the reason I made so many calls is if you were to get fired, normally they'd call you on your internal line first. So I thought, if I never let my receiver down, they can never fire me. And that really was it. Because I thought I'd finish school and go, boom, right, next one. So they can never get through to my internal line. So they can never fire me. But also meant that, yes, I did actually bring in quite a few assets, because I wasn't the most talented, but I was definitely the hardest working. I'd avoid that environment if you can. Yeah, it looks exciting, but it's absolutely miserable and stress and pressure once you're in it. And it actually genuinely turned me into a bit of a horrible person at times. Like, if I could sense someone was underperforming, I'd do horrible things. I'd wait for them to leave the office for the evening at 6, 7. I'd loiter around their desk. I'd look on their notepad, see who their top prospects were, have them lined up. So the moment they're fired, I'm calling their top prospects straight away. So it turns you into an animal, and I didn't like that. So I'm glad it's in the rearview mirror.
Yeah. I have to ask you then, how did you get that first job doing that in the first instance? How did that transpire?
Yeah, it was a difficult one, because I don't come from an academic background. I left school at 15. So for me, it was literally I just put into Google brokerage jobs, because I thought I want to do something respectable with my life, and I can't become a solicitor, I can't become a lawyer. But brokerage, you don't seem to need any qualifications. If you're young and enthusiastic, they'll take you in. They need cheap labor. Yeah. I need a leg up in the marketplace, and it's a perfect fit. So you start off, like I described, a bit of a T-boy, hitting the phones. You build a bit of a reputation. It's like, wow, I've seen that Tim guys. He really hits the phones. And it's a small world. The word gets around. So then after a while, you sort of go to a better job. You have a bit of a reputation. And it just kind of goes up from there and there, really.
Nice. So in terms of what you're doing now, then obviously you're running your own company, you're providing those services on that level. How does TikTok fit into that picture? Because obviously social media is very, very important in terms of the educational piece. But how did you come to land on TikTok? Because like I said, your videos are always very, very informative and very, very real. And I love the fact that you also take the people that try and take the piss out of you. I absolutely love that.
Yeah. I don't really know what the inspiration was behind it. I'm not a marketing expert, but I know I have to learn to run my own company. So you just have to sort of throw yourself in the deep end. If you look at the early TikTok videos, I mean, they are horrific. It's during lockdown. I haven't shaved. My hair's growing out. I look like Frankie Kokoza, a more trampy version. And then after a while, I was trying to be very informative and very, yeah. But then I just stopped giving a fuck and just saying it how it is. And actually, those videos started to do well. So I think for me, it's just a nice way to express what the brand is and who you're dealing with. And it's such a nice community, because then people jump into the comments section and say, I've got this stock, I've got FTSE 250 that hasn't moved in 5 years, and I can respond to that video. And it just creates a really nice community of kind of what we're about as a company. And then, every once in a blue moon, someone will go, I saw you on TikTok, I'd like to set up an account, which is just a nice bonus.
Nice.
But it doesn't bring a huge business, so I just enjoy it.
Yeah, good. So how are you finding things at the moment? Because obviously inflation, interest rates, it's all a bit of a mess from, I guess from an economic point of view and a global outlook. I mean, what's your take on everything that's happening right now? What are you finding?
Yeah, we're on this. As I would say, we're in the middle of the tunnel. Inflation in most places is pretty much starting to peak out now, and we're sort of seeing it now on the downturn, which is brilliant. And where we go from here, we're all sort of waiting around for a sense of where the direction goes now, because obviously we've seen equity markets rally in anticipation of a rate cut, but we're not quite getting it. In fact, there might still be one more rate hike instead of a rate cut.
Yeah.
And for me, I don't really get too bogged down with the macroeconomics on a daily basis, because otherwise it just creates noise. I just stick to the good companies, and I know what the good companies are. I look at their return on capital employed, I look at their free cash flow to price, I look at their earnings per share. And if the company is fundamentally a good company, then the noise shouldn't matter, because these are companies that have ridden out multiple economic downturns. I'm talking about your Apples, your Microsofts, big international companies where it shouldn't really matter. So I'm kind of expecting, once we've had this summer correction, I'm quietly bullish on the market. We should be going into sort of the rate hikes are behind us. We can now focus on a potential rate cut, or at least a pause. companies can catch up. And this economic downturn, it's probably been the most well-telegraphed economic downturn I've ever seen. It's not that sort of 2008 shock and awe that just takes us all by surprise. Yeah, there's no carpet pulling from under our feet. This has been so well telegraphed. So I'm fairly calm about the situation. I'm really happy with the stocks that I've got. So yeah, doesn't faze me too much, to be honest with you. But yeah, corrections happen. It's just part and parcel.
You know what? That's really, really refreshing, because like if you live by what goes on and what is said on YouTube, you will think the world is going to freaking end. It's like, it drives me nuts. And it's like, right, the macro detail is there. I believe that you probably need to understand roughly how it works, but you've made a great point. It's about the companies that you're invested in. If you're trying to pick, the little tittle-tattle companies, then I'm sorry, you're going to be in for a hiding. If you're taking some of these big companies that have been around for a while, like you say, they've weathered the storm of this kind of situation before. There isn't really that much you should be concerned about because they're strong. I think what a lot of, I guess, investors and first-time investors get bogged down in is, what stock can I buy that's going to give me the best return? And it makes some of the bigger companies feel like it's not sexy enough, and it drives me nuts when people say a 7% return. That's rubbish. And I'm like, on what planet? What planet? It's a 7% return rubbish.
It's incredible. And I think there is this real misconception that because the company's so big, they can't outperform the wider market. And so many times I get sort of hit with, Apple's gone to $1 trillion. How much more can it grow? Well, first company to then go to $2 trillion, then the first company to go to $3 trillion. And just when you think they've run out of ideas, bang, they'll come up with something else. Apple Pay, boom. It's a whole new revenue stream. So I'm investing in their innovation, their team of data programmers, innovators. I mean, I quite like the idea that if I were to apply for a high-level job at Apple, my CV would just go straight through the shredder. And I like that. They are very good at what they do, and it's their job. They have billions of dollars dedicated to just creating the next product, the next innovation. So yeah, I think the idea that just because the company's big, they can't keep growing. I mean, Microsoft is a good example. The last 10 years, they've had, I think, something in the region of 26% compound increase in their share price for the last decade, which is just phenomenal. And you say Microsoft, you probably think, what a boring company. But the returns aren't boring at all. They're fantastic,
Yeah, absolutely. It's interesting because Apple, I think you're right. It's one of those, I don't know how they do it, if I'm honest. I mean, all of my devices are Apple. And they talk about the Apple ecosystem.
Yeah.
It's pretty mad the way everything's interconnected. And every single time you think there couldn't possibly be anything else that you can come up with. There's a new idea. Like the VR headset that they came up with. I think I was watching it thinking, it took me back, and I started thinking of the film Ready Player One. That's what I went to immediately. It's like maybe they watched that movie and thought, how can we make an approximation of that in a really nice, cool way? And it puts things like Oculus to shame. It's like
they are so big now. They don't need to acquire a company. They can just turn their hand to a new industry and go, right, let's make a car. Boom. They've got more money. They've got more cash in the bank than I think every government bar 3 or 4. Apart from America, France, China, United Kingdom, they are richer than any nation state. So if they want to set up a car company, they can just do it.
You know what? On that, I went to a wedding in Greece a month ago, and on the beach in just across the coast from Hania. I can't remember what it's called now, but it's the beach in Greece that has the pink sand.
Yeah.
There was a guy who was flying a drone, because I took my drone, and I asked him, so how you doing? He was from New York, and I said, oh, what do you do? And he goes, I work for Apple. Wow. And I asked him, so obviously the VR headset was amazing. Like, he goes, I worked on that. And I said, what's this business about, the car? Do you think they'll do it? And he went, no comment. And I'm like, okay. It's possible.
Tells you what you need to do it. Yeah.
Right. Yeah. He goes, no comment. But he was like, there are some very, very exciting things that Apple are working on for the future.
Yeah.
And obviously they've got the resources and the capital to be able to do that. And they've got very, very talented people working to make it happen as well. So,
yeah. I'm constantly impressed by them. Like I said, it's kind of the place where I could probably never get a look in terms of a job. So that's all you need to know.
Yeah. In terms of like mistakes then that you're seeing, kind of maybe first time investors making at the moment, what are the common ones that you're finding at the moment?
I think impatience is a big one. Quite often you can see someone buy some stock in what is, I would say, a good company in the long term, and it might not do anything for a few weeks or even 3 or 4 months, and they're sort of assessing the performance of a multi-decade company on a 3 month period, which is just crazy. And if it is a good company, providing you haven't bought stock in some sort of crap meme stock like AMC or whatever it may be, or some kind of like speculative Bitcoin, the company's good and they're growing the revenue and they're growing their earnings, then why are you in such a rush? Let them mature and do what they're meant to do. They are there to deliver higher share price. They have a whole boardroom dedicated to increasing the share price. So let them do their work. So impatience is a huge one. And I think people are so trigger happy to just cut their winners. You see a profit, cut it, snatch it. You've just been proven right. The investment is good. It's catching some momentum on the upside. Let it run. Let it do the hard work now. It doesn't care about you. So just let it do its work. So yeah, I think those are the two common ones: is impatience and just cutting winners too early.
Do you think that that's all down to education though? Because I think you're right. I think, especially with social media, because attention spans are so much shorter now,
Yeah,
there is this kind of air of, I need to see these returns quickly. People just don't understand that actually, as you said, it is a multi-decade project. I mean, it's not a quick win. I mean, you might as well be trading if that's going to be your game. Just go learn trading.
yeah,
Maybe not investing specifically.
yeah. Because there's a whole sort of swathe of TikTokers who are dedicated towards sort of technical analysis and day trading and stuff like that. And that is, if you're very good at it and you've dedicated several hours a day to doing that, great, good for you. I'll be honest with you, I think technical analysis to someone who's new to it can be more dangerous, can do more harm than good. If you want to, indulge in your own confirmation bias, you can just find a chart pattern. It's gone down to the 50-day moving average. Oh, but hold on, now it looks a bit oversold. So maybe I'll just look at the oversold RSI, which will just give me that, confirmation bias. I think ultimately these short-term trading habits will just do you more harm than good. Maybe in a few years, once you understand, the fundamentally, you've done it for a few years, you've experienced a few wins and probably a few losses, delve back into it. But yeah, there is definitely the short-term trading nature, and it probably stems on from this whole Bitcoin craze, because people were used to seeing just an asset price go up 40% in a day, and they just think that's normal. It's not normal.
Yeah.
I mean, that's just not how it goes. And there's a really good TikToker, I think it's called Kosher Podcast, something like that, and they talk about you'll win money, but you'll never be successful because you're always going to give that away. It's not sustainable. So yeah, I think the short term nature of it is probably more damaging than healthy, in my opinion.
Yeah. So the prognosis for you, outlook is pretty much positive in terms of the direction of travel you think for investments, but with the near term, would you say?
Always. And generally speaking, my stockbroking career, I'd say, changed a lot when I moved from UK centric stocks to US centric stocks. Yes, there's going to be FX risk. You can't get away from that. But US companies are just focused on nothing but growth. They don't really indulge in a dividend payout scheme or anything like that. They take their money, they reinvest it for more growth. They're so much more focused on growth. So I think that was a huge turning point. So yes, bullish on the market, but I'll take the FTSE outside because I don't really even look at it that much anymore. I'm just concentrating on the US market. I think secondly, don't be afraid to think that maybe it's too difficult, or if picking out stocks is too difficult, then just avoid it altogether. It's risky business. Just do an index tracker. There's nothing wrong with that. I mean, Warren Buffett, he's famous for saying, most hedge fund managers struggle to outperform the S&P 500, just a passive index tracker over the long term. And he's absolutely bang on the money. If you try to get too clever, eventually it's like, you have a few wins, but it's like going to the roulette table. Eventually your numbers are not going to come in and you're going to have a huge hammering loss on some, you ventured out of your safe space, bought some, mid-market speculative stock and just ruins an otherwise very good portfolio. just take an index tracker. There's nothing wrong with that. I do it sometimes.
Yeah. Yeah. I mean, I I mainly use ETFs and index funds for my investing because I just don't. I prefer to have the diversification. It's a wide, varied group of companies that are all large, international, income-producing companies. It's like, why would I want to go and sit there? I mean, I have some individual stocks. I love Tesla. I drive a Tesla. Car helped me buy the stock. So my stocks in Tesla have done very, very well. Extremely volatile. Elon pisses me off sometimes, but it's one of those things where I love the product. I love the car. They are now at this point where they are generating profit. They have got good revenues. They are four leaders in their little bubble. They've got competition now. There's things that they need to get right. But I've got a very small amount of money in those type of companies. Generally speaking, it's in index funds because I don't have to think about it. At least I know that these are good, reliable companies. And yes, it's going to go up. Yes, it's going to go down. But I'm happy to go on that ride, and opposed to me worrying about, did I pick the right company? Oh my God, it's down 10%. What should I be doing? And thinking about all of that stuff. I think there are better things to do in life than being sat there and worrying about what my portfolio is doing and whether I need to move things around.
Yeah, exactly. Because I mean, I've spoken about this actually on a previous TikTok. It's not, the returns are one thing. There's also another thing, and it's like, are you going to be able to sleep at night if you're in a volatile stock? Is it going to concern you if you wake up and something like Tesla's had an adverse reaction to quarterly results and you see it down 8%? How is that actually going to make you feel in your heart of hearts? Because if that's going to cause you worry or anxiety, stop it. Just index tracker, or even that might be too much for you. So it's, yes, the potential returns are one thing, but how's it going to make you feel? Because it doesn't go in your favor every time. One thing I can guarantee, losses happen along the way. It's just parts and parcel.
Yeah.
And if it makes you feel any better, begrudgingly, because I'm not a big fan of Elon Musk either, but I do like Tesla stock. And it is in the model portfolio, very sort of small weighting. But when they started to actually consistently turn a profit over several quarters, and they are still showing in the region of 50% growth year over year, and there's still a whole spectrum of products that they're yet to venture into, I did, despite my differences, well, I know it, but my qualms with Elon Musk, I did buy the stock. So fingers crossed it goes to the moon from here.
But this was really good. So how do people find you on TikTok? What's the best way to contact you if they want to have a little chat or even check you out?
Yeah, I'm always receptive to messages. Just DM me on any social handle. It's at Mitto Markets, MITTO Markets. Mitto Markets on Instagram, LinkedIn, TikTok, or you could just go to mittomarkets.com and drop me an email. So yes, I'm always available.
Awesome. Right. So Tim, thank you so much for joining me. If you have enjoyed this episode, I encourage you, please make sure that you give us either a review on one of the podcast outlets. If you're watching this on YouTube, because this will be out at 12 p.m. on Monday, then feel free to either leave a comment, but definitely smash the like button. It just means that other people like you will get to see and listen to this conversation after it's basically gone out to you. And if you haven't subscribed already, consider subscribing. There'll be more guests where we'll be talking about investing. I've not spoken about investing for some time because everyone's been asking me about interest rates and inflation and just day-to-day finance. It's been quite nice to have this conversation around investing again and talk about some nuances. But hope you enjoyed it. I'll catch you next week. Remember, money is a tool, life's a living. Catch you later on.